All right, traders, it's Friday, May 31st. It's the end of the month. It'll be interesting to see what the monthly bar and the charts look like by the end of the day. Monthly charts are very powerful. Weekly charts also provide a lot of overall trend analysis. And of course, daily charts are just noise. Intraday charts are just volatility. So we're going to skip through a whole bunch of stuff real quick. It's been a couple weeks since I posted a video. I'm getting emails. We're getting comments saying, hey, please post something. We need more updates. So here is a quick update. I'm going to kind of cover a whole bunch of stuff, fresh angles, some big picture stuff, and small picture stuff. But a lot of people want to know about the PCE number this morning that came out in the markets. We can see this morning, this is the 10-minute chart down at the bottom. We've seen a little pop up. This is 9:33 in the morning. So the market's just open, but 8:30 we had the news on PCE, which was to be expected. I do want to touch on one thing. A lot of people are all hyped up about economic data. What is the inflation number and all this stuff? The reality is we don't know what it's going to be. It really is useless info. There's nothing we can do about it, no matter what the value comes out. And depending on people's mindset and what else is in the news and their current vibe and the feelings, the same piece of data that could come out today or next time will have completely different movement on how the market reacts at a later time. So trying to trade around this stuff really is just total waste of time. It's a waste of energy, stressing about it. You just let it come out, and whatever happens, happens. Generally, the news is going to favor the trend that we're already in, which currently the stock market is in an uptrend. If it goes against it, it's usually a shakeout, a flush out. It's really a bunch of emotional people trying to trade the data who are very short-sighted and emotional, placing trades, and usually the market reverses same day or within a few days and then continues the underlying trend, which was to the upside, for example, because we're in an uptrend right now. So try not to get too stuck into all of that stuff. And I've actually pulled up some pretty interesting slides here to kind of cover the markets in a nutshell. I came across this from Stephen Bartlett. It says, your mental diet includes the things you watch, what you read, how you think, who you follow, and who you spend your time with. If your goal is to improve your mental health, start by removing the junk from your mental diet, which get rid of the news, stop following a million different people's opinions, which are all different. You need to find somebody who's in line with what you believe in, what you want. News is garbage. News is junk. Reading a ton of people's opinions is actually junk. You're just going to get a lot of analysis paralysis. One guy says good, other guy says bad. You have to figure out what is your style of trading and investing. Follow a strategy that does that. Don't start jumping around to a whole bunch of different stuff. My whole strategy is we follow price. We don't try and predict it. I could care less what it does. We just follow a trend that shows there's strength behind it, whether it's to the upside or the downside. We just take advantage of it, and we do that. All right, so let's take a look at the big picture here before we dive into the nitty-gritty smaller charts. The key here is to understand the stages of the market. We are in a stage 3 topping phase. Small cap stocks have been out of favor since really March 2001. A really good example of that is simply just take a look at the ARK ETF. If we zoom back to the big picture here, you can see they topped out February, March 2021. They are out of favor, and I do believe they're going to be going a whole lot lower. This ETF could be $16 a share this time next year. So small cap stocks top out. The indexes top out much later. The small cap stocks lead the way generally, and they are definitely underperforming down. Most of these types of companies down 50, 60, 70, 80% or more. And so that is important to understand that we are in a stage 3 topping phase. The leveraged, fast-moving stocks, small caps have broken down a long time ago. The large caps are dragging out, and we are kind of getting closer to the end here of a double top or the market's stalling out and starting a stage 4 decline. So more or less where we are right now in the markets, I believe, is if we look at the overall cycle of the markets, Generally, the markets are always moving up and to the right, long term, like 10, 20, 30, 40 years. We are in this red zone here, maximum peak. There's not a whole lot of upside left in real estate and businesses. Valuations are ridiculous across the board. Things are slowing, as you're going to see. So investing any money right here is definitely carrying a lot more risk than if you let the market and the cycle work itself out and reinvest into businesses, real estate, stocks, commodities, all those things, when the cycle has cleared itself and now you're back into an area where things are fairly valued or undervalued, and then you get to ride up that next move. So if we take a look for a little bit of confirmation, these gray areas on the chart are typically seen as recessions in the markets. Typically, we see the Fed fund rate rally up because the markets are doing well, businesses are growing, the Fed starts ratcheting up interest rates, and eventually things stall out. We go into a recession, and then the Fed needs to start slashing rates to try and save and help businesses in the economy. And of course, we have just had a big ratcheting up phase. I think it's been one of the fastest ones ever in the time frame, or at least in the last 20 years or so. So typically after this, we are going to see a recession. So we are getting closer to things starting to stall out. Now, if we take a look at the unemployment rate, 24-month moving average, this year, every time we cross above the white line, the unemployment starts to cross above the red line or pass through it, we tend to go into a recession. So we've had that, and we're heading there slowly. These are slow moving trends and cycles, so they don't just happen on a dime, which everybody wants, but time has to happen. If we take a look at the COVID, we had the COVID bubble, tons of money, trillions of dollars in excess savings in people's accounts. They have now burnt things up. We're now finally, people have outspent their savings. They're going in debt, and they're out of money to buy super expensive toys and trips and all that stuff. With inflation high, now I've been talking about this for a long time, that people are burning through their capital, and eventually it's going to get pretty ugly. And we're finally getting to this point where we're going to see the market have a big correction, simply because we're going to see consumer spending dry up. People are going to be broke. Credit card debts are going to rise. Everybody's going to do the same cycle as always. They go broke, overspend, and then the market corrects. If we take a look at the commodity to equity ratio, we are at 100-year lows or new all-time lows actually for commodities, saying stocks are so overvalued right now and commodities are undervalued. And this was the tech bubble in 2000. I've been talking about how I believe we're having probably something similar to the 2000, where it's not like a 1 year or 8 month bear market. It's a 2 or 3 year bear market in stocks. And then commodities will rise from the ashes, and we'll see precious metals, probably uranium stocks. A lot of them do exceptionally well in due time, but they will get pulled down with the bear market. And so we are in a major financial reset that is coming down the line here. Now, if we take a look at the cycles of the markets, with this blue cycle here is the stock market cycle. And typically near the top of a stock market cycle, we see precious metals do well. We see energy do well. We also see capital goods, industrial goods do well, which I'll touch on. And usually when we see these things doing well, the market is topping or has topped. And then we're going to go into a bear market for equities. Now, the yellow cycle behind is the economic cycle. And this is where the general masses follow the herd. They're always behind the ball, at least 6 months. I'll touch on that in a minute. But the key here is precious metals and energies are doing very well. If we take a look at, we'll pull up GLD. Actually, you know what? I'll pull up gold. I just prefer. If we take a look at gold, gold pushing up to new all-time highs. Just has been on an absolute tear to the upside. So that is a clear sign that precious metals are doing well and people are worried. Smart money is moving into a defensive play. If we take a look at energy stocks, look at the energy stocks, they're trading up. I can go way back in time here. They're trading up near almost all-time highs as well. They're performing exceptionally well. Again, you think of small cap stocks, they're trading way down over here. The other thing here to look at is if we go to the industrial capital goods. So if we, this is one that catches a lot of people off guard. They don't quite understand it. If we look at the next chart, which is the economic cycle, the stock market, I believe, is in a major topping phase. We're very close to seeing a top. But the general public, CEOs, businesses are all in expansion mode. They've just had multiple years from the COVID bubble, all that money piling in. They have a strong business. They're upgrading their warehouses, their factories, their machines, their assembly lines, their everything. They are ambitious still. They think good times are coming. Meanwhile, they've actually just already ended. But the problem is these factories who are upgrading, they're buying industrial goods, which are new machines and all that stuff. They're upgrading, and that is coming to an end. So if we take a look at the industrial sector, we can see here it is screaming to the upside at new all-time highs. And there's a huge delay with this because these factories order the equipment, and then a year or two later, they have their machines built and delivered and installed, and these companies finally have the big earnings like they have now. So there's this huge delay, and factories and all these people thinking that their business is super strong is about to get hit hard, and they're going to realize they should have just stuck with their old assembly line that was paid for, and because demand and everything is going to dry up. We're going into a recession, and they're going to have this huge expensive line, massive debt, huge interest on their new assembly lines that cost millions of dollars, and it's going to really backfire. So that's kind of where we are in this stage here. Is I believe the stock market is pretty much done, and the general public, CEOs and factories and companies are still very bullish. Yet we already see unemployment starting to rise. We already see rates stalling out. All the leading indicators, the stock market typically always tops first. Investors can see sales slowing. They see all this stuff coming to a grinding halt. So that's why stocks start to move down. People start to move away from stocks. They want to get into different things. So by knowing all of these things, we can apply different strategies. We've got different strategies at the technical traders that across the bottom here, the CGS strategy works in all market conditions, bullish stage 1 through stage 4. That's what's super important, is to understand you need a strategy that evolves and changes automatically with the different stages, because it requires a different strategy, different everything. And if we do that, we end up with this nice consistent growth to the upside. We're outperforming the NASDAQ since the bull market top back in 2007. We're crushing the buy and hold. It's just slow and steady, consistent growth. So far this year, we're up about almost 10%, while the rest of the strategies are up. The QQQ, the SP 500, the 60/40 portfolio are all just kind of treading water and slightly positive. So that is kind of the whole gist of what we're doing. So let's just go back and take a look at the markets for today. Let's just pull up... Let's take a look at the monthly chart just to kind of wrap things up. Overall, the market today, lots of volatility because we have news. If we take a look at, I am going to go to the SP 500. If we look at the SP 500 chart, you can see we've had a month pullback to this 5-day move or 5-period moving average, and we found a nice pop, and it is starting to rally back up. This is still a very bullish chart pattern, pointing to higher pricing. If we take a look at the NASDAQ, similar type of price action, it's actually closing above the previous month's high, so we've got a good sign there. If we take a look at the Russell 2000, Russell 2000 is struggling a little bit more. It's definitely been more into a topping phase. This is kind of this stage 3 topping phase where it has a little bit of a blow off, breaks down, has this kind of complacency move before it eventually falls off a cliff and heads lower, which we can see right. We can see right here. So this is the stage 3 top, a complacency. People think the markets are starting another major rally. This is what the majority of stocks and sectors are doing. They're flagging out here before they go into a stage 4. Again, stage 3 topping phase, super dangerous. Other than that, I think that's about it at this point. Let's take a look at crude real quick. Crude is up 0.25%. it is flagging sideways, trying to figure out what it wants to do. In the grand scheme of things, it really is just kind of in the middle of its range. If we were to just throw on a bar here and a bar down here, it really is just trading more or less in the middle of its range. So it's just in no man's land, trying to figure out what to do. And again, we go into a recession, especially when they say we're in a recession, we'll probably see this fall off a cliff and head back down to the low 40, 30 area, which it has done many times before. And it'll kind of definitely re-cleanse the markets. Now, some of you may know I was recently in London, UK with my partner John for the Goldilocks Mission, which is a movie that we're doing. John was a keynote speaker. We're talking about weaving in education around climate and clean technology to kind of inspire and educate the world about how we can all make this planet a better place and get to that net zero carbon for the planet and some future date to preserve the world for our kids. Now, we do have a pretty amazing movie. John has featured 10 films on platforms like Netflix and Prime and other places like that. So we are putting a movie together. I do want to mention that if you've got a really cool product, it doesn't have to be in the clean tech or space like that, but if you've got a really cool product and you want it seen on the big screen in a movie, we've got a really cool package away. We're working with some creators, makers. I'm a maker, inventor myself. So you can take a sneak peek at the teaser of our show and what we're offering, and we can get your product seen around the world in our movie and become part of this movement to help more or less educate the people on how we can make the planet better from that perspective. So we've got a cool package. If you're interested, I can send you this package to get seen on it, and we'll go from there. Anyways, that's it for now, guys. Take care. Bye-bye.